Welcome back, Focus Learners, to today's Explainer. Oh man, I am absolutely thrilled to share this one with you. Today, we're taking a truly legendary brand and putting it through what we call the Guru Gauntlet. It's incredibly fun and honestly super revealing to put a company's financials through the ringer and rigorously test it against the classic frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, alongside some modern discounted cash flow modeling. Our subject today? The Hershey Company, ticker symbol HSY. We're going to break down their Q1 2026 data to see if its current stock price is a sweet deal or just a sugar rush waiting to crash.
Okay, let's dive right into our roadmap for today. We'll start with a quick Hershey snapshot, then look through the Buffett lens, the Lynch lens, and the Graham lens, before running some DCF and other models. Finally, we'll wrap it all up with our synthesis and verdict.
All right, starting things off with Section 1, Hershey's Snapshot and Financials.
To really understand where Hershey is going, we've got to look at their current market reality based on the latest Q1 2026 filings. $183.91. Keep that number locked in your head, okay? That is the current stock price, and it's literally the ultimate target we're testing all of our valuation models against today. Is it justified? Well, to figure that out, we first need to know what that price is actually buying us.
So globally, Hershey is this massive $11.7 billion giant. But as this chart brilliantly illustrates, the core engine driving those financials is heavily concentrated. Just look at Q1 2026. North American confectionery brought in nearly $2.5 billion. Meanwhile, Salty Snacks International are just, well, small slices of the pie, sitting at $350 million and $264 million respectively. This intense, US-centric brand concentration, that's going to be absolutely crucial for our Guru tests.
Moving right along to Section 2, the Warren Buffett lens.
When the Oracle of Omaha looks at a business, you know he's searching for highly consistent earnings, manageable debt, and above all else, an economic moat. Think of it like a giant castle wall protecting a company's profits. But sitting here amidst this intense 2024 and 2025 cocoa crisis, where cocoa literally surged past $12,000 per metric ton, we really have to ask ourselves, does Hershey actually have a moat strong enough to defend those margins?
Well, what's really interesting here is that we can actually see empirical proof of that moat in action. During Q1 2026, Hershey successfully raised prices aggressively. We're talking 10 points of net price realization overall. And in North American confectionery, they absorbed only 4 points of volume loss against 12 points of price increases. I mean, that is just incredible consumer loyalty. Because of this massive pricing power, they're guiding for 30 to 35% earnings per share growth this year, plus a projected 400 basis point margin improvement. Consumers just kept buying, even as prices went up. That right there is a textbook economic moat.
Let's walk through the exact calculations extracted from the Q1 balance sheet to finish up Buffett's checklist. Return on equity? Exceptional. We're projecting roughly 35% based on estimated net income against $4.73 billion in stockholder equity. How about debt? They do have $4.68 billion in long-term debt, but with an annualized operating profit trending toward $2.7 billion, that's highly manageable. Finally, owner earnings, which is essentially net income minus capital expenditures. Taking that projected income and subtracting the $450 million in guided capex leaves us with a highly cash-generative $1.22 billion. So, Hershey passes Buffett's qualitative checks with flying colors. However, Buffett always demands a margin of safety. If we apply a standard 20% discount to its cash flow power, his ideal buy price would actually land somewhere around $140. So at $183.91, it's a wonderful company, for sure, but perhaps not at a wonderful price.
Let's shift gears to Section 3, the Peter Lynch lens.
Now, Lynch focuses heavily on the story of a stock, categorizing companies into specific buckets: slow growers, stalwarts, fast growers, cyclicals, turnarounds, or asset plays. So ask yourself, based on what we've seen so far, what category do you think a 130-year-old chocolate company falls into?
Normally, Hershey is your absolute classic stalwart. You know, a huge, dependable, dividend-paying machine. But here is the fascinating twist for 2026. Because of their immense pricing power and the rapid recovery from that cocoa crisis, their projected EPS growth this year is sitting at 30 to 35%. So temporarily, this totally dependable stalwart takes on the high-octane financial profile of a fast grower.
And let me tell you, that specific growth rate does something absolutely magical to Peter Lynch's favorite metric, the PEG ratio. Let's do the exact math here. First, we need the price-to-earnings ratio. We take our price of $183.91 and divide it by the projected EPS of $8.20. That gives us a PE of 22.4. Now, you divide that 22.4 by the 32.5% midpoint growth rate and, wow, we get an incredible 0.69. For Lynch, any PEG ratio below 1.0 is a massive buy signal because it means you're paying a very reasonable price for explosive growth.
Which brings us to our strictest test yet, Section 4, the Benjamin Graham lens.
Benjamin Graham, the father of value investing, is famously strict. He demands a massive margin of safety and really tangible asset backing. So let's run Hershey through his defensive investor checklist. Adequate size? For sure. They've got $11.7 billion in revenue. Strong financials? Yep, with $3.76 billion in current assets against $3.03 billion in current liabilities, their current ratio sits at a very healthy 1.24. Earning stability? Check. They've got a long track record there. But then we hit valuation. And this is the crucial point. Even though Hershey's balance sheet is strong with over $876 million in cash, Graham strictly demands a moderate price-to-earnings and price-to-book ratio. With a PE of 22.4 and a price-to-book of 7.9, Graham's checklist immediately flags this stock as way too expensive for a deep value investor.
If we break down the explicit math of the Graham intrinsic value formula, this becomes even clearer. We take the square root of 22.5, multiply it by the $8.20 projected EPS, and multiply that by the $23.21 book value per share. Our calculated intrinsic value? Just $65.43. So honestly, Graham wouldn't touch this stock at $183.91. It entirely lacks his required margin of safety based purely on hard assets and earnings.
All right, let's look at the hard quantitative numbers in Section 5, DCF and other valuation models.
To build out our base case DCF, we have to make some informed assumptions to fill in the gaps based on our sources. We estimate a starting free cash flow of roughly $2.25 billion. We actually get this by taking their Q1 operating profit pace and subtracting the $450 million in projected CAPEX. From there, we project steady growth into year 2 and year 3. Why? Well, market intelligence reports show that as Hershey's expensive 2026 cocoa hedges start to roll off, they're going to start buying at much lower spot prices in 2027. That creates a massive structural cost reduction of 30 to 55%.
So, if we discount those flows back to today, explicitly using a standard 7% weighted average cost of capital, or WACC, and a conservative 2% terminal growth rate for a mature candy business, what do we get? Looking at our sensitivity table, our base assumptions land the fair value right around $158 per share. What that suggests is that the stock, sitting at nearly $184 today, is actually slightly overvalued by the market.
And if we quickly compare a couple of alternative models, the picture stays pretty consistent. A peer-based comparable PE analysis, assuming a healthy 20x multiple on that $8.20 EPS, gives us a fair value of $164. Meanwhile, a standard dividend discount model based on their dividend payouts and growth yields a much lower fair value, right around $100. So both of these alternative models are definitely yielding fair values lower than our current trading price.
Finally, let's wrap this all up in Section 6, Synthesis and Final Stock Verdict.
Synthesizing this whole gauntlet reveals a really fascinating split. Hershey's strengths are absolutely undeniable. They possess incredible pricing power, exceptional U.S. brand equity, and a huge 30 to 35% earnings growth catalyst this year. That right there makes it a screaming buy for Peter Lynch. But the risks are heavily reflected in the valuation. That premium price of $183.91 essentially prices in almost all of this current earnings boom. Buffett would call it a hold, probably waiting for a $140 entry point. The DCF and comparables suggest it's slightly overvalued too, also pointing to a hold. And Benjamin Graham? Well, he's a hard sell until the price crashes way closer to its actual book value.
Which leaves us with this final provocative question. You've seen the data, you understand the frameworks. Is Hershey's remarkable brand loyalty and future margin recovery strong enough to completely defy this strict value investing math? Or is $183.91 a sugar high that's just destined to correct? You really have to weigh Peter Lynch's growth optimism against Benjamin Graham's strict value pessimism. And guys, this, focused learners, is exactly why structured, multi-framework analysis matters so much. Keep learning, keep analyzing, and I'll catch you in the next explainer.